Good afternoon, ladies and gentlemen. I am TomPow, your servant and the super chairman of the Federal Reserve. I welcome you all to this meeting to discuss the latest developments in the U.S. economy and federal open market committee policy decisions. Since our last meeting, we have faced significant challenges, and unfortunately, another bank has fallen and been taken by the Federal Reserve due to insolvency concerns. We understand that at this time, there is difficulty in the banking sector, and we are committed to ensuring the safety and soundness of the financial system. Today, we will be updating investors on our expected 25 BPS interest rate hike and providing forward guidance on our policy stance for the remainder of the year. We are aware that regional banks are under pressure, and we will carefully consider the risks to insolvency as we navigate our policy decisions. As always, our primary goal is to promote maximum employment and price stability while maintaining the safety and soundness of the financial system. We understand that our decisions have significant implications for the economy and financial markets, and we take this responsibility very seriously. Now, ladies and gentlemen, I have some good news and some bad news. The good news is that the financial world is never dull. The bad news is that it's getting downright hilarious. Have you heard of meme coins? These are digital currencies inspired by internet memes, like Pepe, which features the famous face of a frog. And it seems that people are investing in these coins faster than they can say YOLO. But what's really tickling my funny bone today is that people may be pulling their money out of traditional banks and putting it into these joke-inspired coins. Who needs a steady, predictable return on investment when you can have a cartoon frog? All jokes aside, we take the risks facing the banking sector seriously, and we are committed to ensuring the safety and soundness of the financial system. But maybe we need to spice it up in our marketing approach here at the Federal Reserve. How does FedCoin, the currency that's too legit to quit, sound? Or buy low, sell high, and always remember your monetary policy tools? Okay, maybe we need to work on that some more. But in all seriousness, we will continue to monitor developments closely and make necessary adjustments to our policies as appropriate. Thank you. Now please, grab a brew, roll it up, like, subscribe, and kick back while I decide which button to push.
Walk out the door, you see someone that you know and they ask you how you are, and you just have to say that you're fine when you're not really fine, but you just can't get into it because they would never understand.
They would never understand. They would just never understand. Whoa. What's up, everybody? Today is that special day, the best day, the hypest day of the month. The FOMC meeting is minutes away. Our schedule today, thank you. I want to also thank Tom Powell for joining us today. He's so hard to get on the show, but shout out to him. That was a great introduction, maybe the best one ever, probably in the history of time. But we are minutes away from the Fed's decision, and with no overstatement, it is going to be historic. The Fed has two buttons to push. Both have fallout, and neither solves really anything. We're going to see a Band-Aid, or we're going to see, I don't know, the struggle bus going to get loaded up here. Stocks are rising, apparently, while the dollar is falling. Bitcoin, I actually haven't looked at because I've been so focused on getting this steady and ready for you guys. All I ask in return is that you smash the like buttons, put something in the chat, hype it up, share it, engage, and be with us today because it's going to get crazy. No matter what they decide, the market is going to have fallout, whether they continue forward with the interest rate hikes this year, whether they pivot, it really doesn't matter, and that's what makes today so dang special. Let's take a look really quick here at our Fed rate interest decision predictor model. We can see that 0 BPS has declined heavily since last week. This was almost favored a few weeks ago. 25 BPS coming in hot with an 88% chance or probability based on whatever data they use. I don't know how they come up with these. Maybe they just ask people their opinions and then who knows? Maybe they ask ChatGPT. Doesn't really matter. Bloomberg released this today. Their source, JP Morgan. This is their game plan on Fed Day. So the predicted rate cut probability less than 1%, up as much as 2.5%. No hike and pause 5%. They expect to see stocks up as high as 1.5. Hike and pause at 55%. This is the one I think is the most likely. There's always the possibility of a wild card. Vote in the poll. Please vote in the poll. Let's hype that poll up. They would expect a 0.5 to 1% increase in stocks and a hike and continue at 45%. So we see a roughly 95% chance, according to JP Morgan, that we're going to see a hike and pause or hike and continue. So basically, the market's looking for a hike. It's been pricing it in, and I just can't freaking wait. I don't even remember if I went over the schedule, but in 20-ish minutes, we're all going to collectively start Googling, and we're going to see if we can find this decision first. We had some really big numbers this week. I'm almost afraid to hit this button. Big numbers across the market. Last week, we had a shocker of new pending home sales down 5%. Jolt job openings we see are down this week. ADP, non-farm employment changes up against forecast. Okay. Crude oil, never really care. Interest rate decision, FOMC. Jobless claims tomorrow. It's kind of backwards, isn't it? You'd think they would do this first. Typically, the Fed looks at jobless claims, the economy, what is it? Jobless claims and inflation. That is their typical dual mandate. However, there is spiciness in the mix. This year, we have seen 4 U.S. banks collapse or be seized by the Fed, and these concerns are going to weigh heavily. And while they may not outweigh unemployment and price stability with inflation, I think there's an argument to be made that it in fact does. One bank collapsing leads to others. This is not a good situation to be in, and that's what makes today just so freaking spicy, guys. Let me rip up the chart. We have prepared our typical FOMC chart. Let's get on some tunes. Whew, I'm still feeling the hype. Still shaking a little bit. Our typical chart is up. Let's get our typical music up. Let's see. Approaching Nirvana. Sure. We'll do this one. I think the intro went without a hitch. That's great. Camera didn't freeze. Connection didn't cut out. That's 10 out of 10, baby. Music's not playing. There we go. Let me know what the volume is. We have our chart up. We can see the market's already reacting to TomPow with extreme volatility. Just kidding. Nothing's really happened yet. There we go. Nothing's really happened yet. We have Bitcoin up at the top, the dollar in the middle, and S&P 500 representing stocks for us today down at the bottom. We're going to be keeping a close eye on these charts throughout the meeting. We do have a typical game plan, but as I get into it today, I do want to say a few things. One, shout out to our sponsors, Femex, Fairdesk, and Market Cipher. Their links in the video description below. Sign up using my link to support the channel for free. It's also pinned to the top of the chat at tomcrown.io. Second, my caution or my word of warning for everyone is we have done this. We are the original channel covering the FOMC. We were doing it long before anyone thought it was interesting. Somehow we managed to make it popular. Now everyone's doing it. I want to thank every single one of you that is tuned in for these and is here today with us at the OG. You guys are the OGs now of the FOMC meetings. Thirdly, I guess, these have extreme volatility in the past. I do expect today to have maybe the potential. No, not even maybe. I expect today to have the potential to have even higher volatility than we've seen in the past. I do not plan on opening any trades going into this. I do not plan on. I kind of wish I wasn't in any positions as is already. It is very, very risky. We do tend to see, we'll go over our little diagram here, whatever direction the market is trending in, we tend to see some pretty predictable behavior. Let's say, just for example, let's just say Bitcoin's trending up. Typically, we'll see it move one direction into the interest rate decision, reverse as it's published at 2 p.m., and then reverse again when Chairman Powell speaks, and roughly we end up right back where we were. Now, today may be different. We may see even more extreme volatility. We may see this pattern that we've observed over the years not play out as it has. There are no guarantees in trading. It is all risk. Please manage your risk today. That is my biggest wish for all of you. Please don't get wrecked. Please don't bet the farm. There will be more days to bet the farm, and today is likely the roughest one. So we already have 1,000 people viewing. We are only 14 likes away from 420. What are you waiting for? Let's get 1,000 likes. Let's get 4,200 likes. Let's pump it up. The more you engage with the stream, the more YouTube will think that you guys are enjoying it. So even if you're not, you can just pretend, and it will show it to more people, and our fam will grow. So let's keep that hype going. Let's keep it sharing. And we'll go over really quickly while we have a few minutes. Let's just go over where things are at right now. So getting rid of all the noise on the chart, adding the dollar watermark here so you know what we're looking at. This is the dollar on the daily time frame. This is going to be the focus today. I see chat going nuts, guys. Keep it up. Keep up the hype. Let me enable the alert box. I didn't want to have an alert during that intro. Okay, alert box is back up. I do want to shout out. We have a bunch of new subscribers. Shout out to Michael Height, KC Crypto KML, Mendy Pimentel, Beardy Boy, and Ferdacoin. And I see Muhammad, our boy, gifting away some memberships. If you'd like a membership gifted to you, make sure you've enabled them, opted into it. Engage with the stream. YouTube says it is random the way it gifts them out. However, it favors those who have engaged with the live content. Let me put the FOMC up here. Thank you, Muhammad, my man. Yeah, did that play? I hope so. Oh, there it is. Crypto Surf. Congrats, my friend Sudeep, my boy. Where is Bajarki? Pray for Bajarki. Pray for Spice. Pray that you get the membership. If you are gifted one during this live stream, do us a favor. Put some of those new emojis in the chat. We worked hard on those. Shout out to Magi for doing the labor on those. Appreciate you. Appreciate you 100x. 100x long on Magi. Woo. We're ready. I guess I can't mute it. Anyway, the dollar will be in focus today, for sure. And what are we seeing going into the meeting? The dollar hitting its high in September, finding a low in January of this year. Kind of a pathetic rally, and we did see in April that low in January break. I'm not seeing a lot of energy here in this weekly candle. We have looks like a local higher high on the dollar into a bearish hammer candle with 2 days and 6 hours to go. The dollar is struggling. It is struggling today. However, reminder, typically when the dollar goes down, we see stocks, equities, assets move up. This makes sense as they're priced in dollars. Today, all of the things that we know to be true may not function. We may just see wild volatility stopping out traders long and short alike. And let's see, man, that's not looking so hot, is it? Poor dollar. We were looking for a retracement or dead cat bounce. I don't really think that this was it. I've been saying that in March. But we might be seeing some kind of megaphone pattern play out here. This is a weird move by the dollar. That lower low in April kind of putting a nail in the coffin in the bearishness, coming off of what looks like to me a blow off top in September of last year. The dollar is struggling. It's struggling. Let's take a look at Bitcoin too. Might as well look at this. We're looking at a fractal. I just wanted to update you guys. While we did say the fractal is dead, what's up, Jack Baldry and Aaron Gold subscribing? You are the real MVPs. We were looking at this fractal on Bitcoin. I'm not going to go over it 100% because we don't have enough time today to go over everything. But basically looking for a repeat of the post-2020 crash in markets. We have this white box described by flat price action, consolidating volatility, an explosive move to the upside that retraces and then paints lower highs and higher lows until it broke out to new all-time highs. The reason we're keeping an eye on this is price action right now is still looking pretty similar. The swing low in late April was a little devastating to it, but we've said we might as well continue to follow it as long as we get lower highs and higher lows. And so far, it's actually worked out, and I've even traded off of this. This low was a little sketchy on our fractal, but we've seen our highs come down, potentially on the 1st of May, a higher low, and price action, at least at the moment, does look to be moving back to the upside, so waiting for a lower high. And we've drawn this a million times, we'll draw it a million more. This is what we're looking for. If this remains in play, we may see an explosive break to the upside. LFG. Our bullish megaphone pattern has been ultimately disrespected by price action. We painted this out in March, but it is still in play somehow. I have no idea how or why, but we're seeing that ascending trend line pretty much hold price. We have had some sketchy closes on the daily and down to lower time frames as well, but price seems to be interacting with it. We speculated the same thing I just doodled, that we may see price move in a flat top or ascending triangle. Triangle. And at the moment, things are actually really still in play. I'm surprised. This was our original pattern. Let me really quickly. Original pattern, we were looking for this bullish megaphone. This was early in March. Whether it's broken now or not, it certainly was an amazing guide. It was very accurate to price action. We saw the 1, 2, 3, 4, 5 touches, as is in the diagram. And this was before price broke through 27K. So this has really done us well. Fingers crossed. Pray for the bullish megaphone. Pray for Gina. Notice me, Gina. I love you. Gina. Notice me. Let's see. Coming back. All right. We do seem to see Bitcoin moving up into the interest rates approach. Not the best take, at least according to our history or what we've seen in the past, as it does tend to reverse at 2 p.m. when the decision comes out. It is currently 1:42. That means we have roughly 15 minutes to grab a brew, roll one up, let's blaze it, like, subscribe, hype, etc. And it looks like we're actually starting to get some volatility already. I love it. This is why I do this. These are the days that I stream for. I love FOMC days. Let's take a peek at stocks. Stocks also looking a little bullish as the dollar is showing some weakness today. Honestly, this is going to be so wild. The timing of everything is insane. We've been watching stocks as we always do on this channel and basically looking for a pattern we pray for in crypto, which is that flat top with our lows coming up. We see that here, each consecutive low higher than the previous, top being flat. All of this could change today because essentially on stocks, we've been saying, man, it looks good, but under 4,300 on S&P 500 it's just a no trade for me. I need to see the high break there. We can continue doing this dance here, but I'm not convinced. I don't think it's... No, I'm not taking a position here. I want to see 4,300 break to convince me, and then preferably see a pullback to enter on. But at the moment, this really has pulled out some kind of miracle on stocks here. It might not appear that way just looking at the chart, but I bet if I invert it, you'll start to feel me. That's looking pretty toppish on the inverted chart. All of this could change over the next hour when Chairman addresses us live. Can't freaking wait. Let's move these back down. We're going to move them on to the 1 minute time frame because that's the most degen thing I can think about. It's the most degen thing I can think of. And here we are on the 1. Little bit of movement into the decision. I like it. Let's go. Where are we at now? Yeah, solid 1,300 viewers. We're still 15 minutes away from the decision even being in. Plenty of time for more hype. We've blasted past 420 likes. Well done, fam. What are you guys feeling today? Let's look at the poll with 1,200 votes almost. 60% of us looking at 25 BPS. That is the expected prediction, and that is very likely what we will see today. However, you never know. They're called surprises for a reason. They're not likely, but they happen anyway. What is up, guys? What's up? I see so many people. So many people in the chat. Let me just shout out some of you while I have a moment to do anything. I see Aaron Winkler, Alex Wells, Alexi Cruz, my boy Alfresco, Andrew, Baxter, Churchill, Beardy Day, Big Tuna, Bit Pro. I saw you before the stream. Shout out to you, my friend. BK Ebby, Brandon FC Ron, Captain FOMO Hodel, Chad Simmons. Nice, Chad. Cherry City Bullsy, Colin Stoltz, Corey, Crypto 101, Crypto Poppy, Coins Check, the Girl of the Hour. Published an awesome article on crownanalysis.com today. Check out crownanalysis.com. Cryptogenic Dude, Crypto Steve O, my man, Danny, Dave Digital, what's up, bruh? Derek Miller, Draco, E, VDZ, Eli Sater, Fletcher Wiggin, Frankie Tenky, Coin Out Flanky featuring Wick. I feel like you do these names just so I say them. Well played. Falcor, Falcarul Mishu, what's up, man? Go F to the Moon, Ice 3112. I'm my hero. For some reason, I always say in my hero every single time, and you're here all the time. Itadaki Masuso, the person whose name I got correct. It's Autopilot, Jack Hinarak, Jason Caitlin, Jeremy Ragsdale, my man. What's up, dude? John Doe, John Johnson, John Paris, John B, Jojo, Jonah Plainclothes, our boy. Joshua Gonzalez, Juggernaut of Crypto, Justin Burdick, K. Bahamut, King Future, King Peasant. Many kings here today. You're all kings in my opinion, or queens, whatever you want to be. Krishna Morisa, Chris Pax, Kyle G, Lamps, Lean Official, Liquidated Shorts. Likely today that name will hold true. Loading Name, Love Jeets, LT, Mad Cow, Maxi, Marksy, Matt Stoner. What's up, Matt Stoner? I know Matt Stoner. Matthew Barnes, Moggy. How you doing, Moggy? Max Antenna, Metalin Both Legs, Michael H. What's up, Michael? Mihai. Wow, these names, everyone just going nuts. The list just keeps updating. Mike Volmer, Mode Master DK, Mohed Harfik, Andy Walk, Muhammad Al Maskari, Mutant Ape Nobody, Name Here, Nate Quantum. What's up, Nate Quantum Divergence? NBF Net Star, Nikki Page, Nico Lozy, Nut 4 Case Giggity. Oh my, oh no, Y2K, Paul Wood, Peppa Rocha, Pink Floaty, PK, Paula, I can't say her name, bro, you know that, but shout out to you. Rip2, Robert Louie, Luau, Rolling 69ers, Roland Washers, Ryan and Brooke Montgomery, both of them. Ryan, I can't even keep up. I'm trying. There's just too many. You guys are blowing me away. If you're out there and you haven't subscribed yet, you still have time. Be like health's secret and subscribe. Join us, fam. We are the original FOMC channel. We've been doing this for years, way before it was interesting. I see Sylvan Sin. Cheers, fam. T-Bone. Also, fam. Taku Taylor. Applegate Experience. Good to see you, man. Classic IT Guy. Crypto Cisco. Who else is here? FUD Expert. I see you. Astral Projection. Is that real? Can you really astral project? Is that a thing? I don't know. Faster. Chirpow. Can I get a Chirpow in chat? FOMC Gal. Viva Pepe. You got this, non-subscribers. I believe in you. You can upgrade yourself today just by hitting that button. Let's get it. Let's get it, boys and girls. Woo. That was a lot of words. Cheers to Optical Art. Where's Steve? Is Steve here? What's up, Michael Parker?
Tom, love your energy. TBH, I only watch you on FOMC days and you do a great job. Appreciate you.
Thank you, sir. It's different content. If you only tune in during FOMC days, that's fine. No judgments. Where's Steve? He said he'd be here. Not Crypto Steve-O. Where is Optical Art? I wanted to shout him out, but I don't see him. When Steve? If you missed TomPow, the legendary TomPow, he was just on. DVR is enabled. You can go back. You can go back and watch him. He had a lot of really insightful stuff to say. Yeah, you can't miss that. Super chat so rude. Not rude. I appreciate you, Michael Parker. Thank you for the super chat, my friend. Good to have you here. Optical was here. There he is. There's Steve. My boy Steve. Let's shout out Steve. Let's go to his channel. Follow Steve. Follow Steve. Let me put his link in the chat. Great guy. He is the bear to my bull. He is the yin to my yang. The balance. There you go. Link in the chat. Follow Steve as well. He'll balance out my bullishness. If you think I'm too bullish, he'll balance it out for you. There it is. There it is. Almost 1,700 viewing. We're going to get those numbers up. We have 10 minutes until the decision is in. Big pow energy. I like that, man. I like that. The only spice is Gina. Well, she's my spice. You stay away from her. She's mine. She's mine. We have less than 10 minutes to go until this decision is live. I want everyone who's on a PC, don't do it if you're on mobile, but I want everyone on PC to pull up a tab. It doesn't have to be Google. In fact, better we use many different search engines. We're all going to Google at 1:59 to 2 p.m. For 60 seconds, we're going to hammer these search engines for the Fed interest rate hike decision. We want to find when it's published. We want to be the first ones to know. And we're going to crowdsource this as we do every month. What I want you guys to do is Google it away. I'm afraid to type anything in because who knows what my search history is going to come up with. Been Googling some weird stuff lately. But what I want to do is put in the chat the interest rate decision that you find, but please include a source. Please don't just randomly put in 25 or something. That doesn't help us. We need a source, and the source has to be published after 2 p.m. today. That's the caveat. If it was published earlier than 2 p.m., so literally anything published on the internet right now doesn't count. Rate decision. Okay, so my search history didn't show up with anything weird. So something like this, Fed interest rate decision, let's say like May, I don't know, 2023, right? Little life hack. If you go to tools, go to any time, put in like past hour. Once 2 p.m. rolls around, you're going to be looking for something that's published within the last minute. Has to be past 2 p.m. We got 8 minutes to go. The hype is building. The fam is here. Let's see. Corn made a move to the upside. Almost as predicted. Looks like it's coming on back down. Hopefully it is trending down into the rate decision. Or do we want it to trend up? At this point, I don't even remember. I don't even remember what I want. I don't even remember. That is just minutes away. Not even 8 minutes to go. Corn is actually roughly where it started. Stocks weirdly are down. This is different. This is different. Bitcoin made a little move to the upside, and we're talking micro move. Stocks made a micro move to the downside. It looks like the dollar. This is weird. This kind of happened last time too. We had not what we would expect. I did warn you guys earlier. Today is probably the most risky day to trade. I do not recommend it. I heard a ba-ding. Turn it on the heater underneath me. It's chilly in here. Is it cold where you guys are? It's freaking freezing here. It's supposed to be summer. I see Johannes Crypto subscribed over on Twitch. I don't know how you found it, but you found it. Channel Pattern Trader subscribe. Shout out to you, my friend. Shout out to you. And everyone else who's out there yet to subscribe. Cheers. Cheers. Almost 2K peeps. That's right. Almost 2,000. If we keep hyping the channel, if we keep hyping the chat, the likes, sharing, engaging, we will get way past 2,000. Target is always 4,200 or 6,900, whatever. 420, 69, giggity. Blaze it. 50 BPS would be great. 50 BPS would be chaos. Honestly, I think it is more likely they do a negative hike than a 50. If there's a 50 BPS, I think we see some crazy stuff happen. Like, out of control crazy. Probably very bad. Pooney, following on Twitch as well. We're not live on Twitch. We haven't been live on Twitch in like 2 years, 3 years, but hey, whatever. I guess you guys are finding it. It's a secret. Maybe I'll start dual streaming there. I don't know. I'm too lazy. Definitely not today. Hit the like, says T-Bone. Thank you, my friend. Aaron Pym, rocking it as usual, mate. Thank you. Thank you. Appreciate you all. Nice video. Thank you, Master Sniper. Small time frame cup and handle. Yeah, sure. Sure, why not? Really, I think what happens is into these market participants start taking positions because they're degens and they want to lose their money. That's my opinion. And basically just push the markets around a little bit. They FOMO in one direction into the decision, and then as soon as Powell speaks, they FOMO back in the other decision, and we typically see both sides of the trade liquidated on Bitcoin, and honestly, even on stocks. Really don't recommend you open a trade today. I think it's too risky. If you are going to, at least use my link. I don't know. Sign up using my link. We are going to do a giveaway at some point. If you commented on the last live stream, your user ID from Fair Desk and you signed up using my link, you'll be eligible. But that's the last thing of importance right now. That's not going to be till later. Degen Maximus. I like that, BG. Can I get a chirp-pow? Chairman Powell. If you guys aren't familiar and you just like the chirp-pow, I've found that everyone likes chirp-pow. Like, I told my mom, I've like referred to Jerome Powell as chirp-pow, and she's like, I like that. That's fun. If you're not familiar with where it came from, as I said, we're the original channel to cover these. No one else was covering these when we were. And what we noticed is at the question and answers part at the end, people constantly would combine the words chairman and then Powell, because they're supposed to address him as Chairman Powell. And they would combine them, and it sounds like chirp-pow. Mr. Chirp-pow. Mr. Chirp-pow. Well, there you go. There's the history of chirp-pow. And the Fed. Maybe it's time. Maybe it's time. They certainly don't have many good choices here today. You're an Optical Art subscriber. Can you give me the sword to draw another line? You take all the swords you want, Sir Luis Felipe Caetano? I don't know. Great name. A chirp-pow. That's right. A chirp-pow. I'm going to put some, let's put some of these Bajarki emojis in chat. Shout out to Bajarki, wherever you are. That is the last god line. The last of the god lines. Shout out to Steve again. Double shout out, Steve, because I don't know, man. I love you. Bulls and bears can get along. And in fact, if you want to be in this market for any considerable amount of time, you got to learn how to hear out other people's opinions, consider other people's opinions. At times, how do I phrase this? Steve and I rarely agree on TA, but there's been times where I've been totally wrong and Steve was right. And there's been times Steve was wrong and I was right. It's like no one is right all the time. Get your information from more than one person. Don't just listen to me. And in fact, I'll go a step farther. Please don't blindly just listen to what I say. I mean, you can listen, but don't blindly follow what I say. There we go. Definitely follow me, though. Subscribe. Follow. Jump in the Discord. Follow me on Twitter. I'm a master crap poster. Here we go. It is 1:57. We have 2 minutes to go until the interest rate decision is published. Why they do it this way, I have no effing clue. Couldn't tell you. Couldn't tell you why they do it this way. Seems really weird. I guess the Fed, like, slips news, whoever news they decide to, the decision, and then they come out a half an hour later and say it. Seems really weird, but isn't that just kind of typical of government? It's like, why not just be public about it and open? Nah. That'd be too easy and logical. We're going to do it a weird way. 2 minutes to disaster. Bum, 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 Nikki Page. Less than 2 minutes to go. Fam, make sure you've liked and subscribed. We're going to all open our tabs if we're on a PC. We're going to be Googling. We're going to be refreshing the page. You're going to see these ones 57 minutes ago, 24 minutes ago. They don't count. None of them count. Literally nothing that could ever show up right here, right now, will count. We need something that's published after 2 p.m. When you find it, put it in the chat. Also, put the source. Please don't just put a number. It's not helpful. But I don't know. You can still just put a number. It is what it is. We have so little time. We are now 65 seconds away. Get hype. Get hype. At the moment, Bitcoin back to where it started. As if we didn't expect that. Back to where it started. 28.4. Oh no. 28,475. Why are so many people subscribing on Twitch? I don't know. Ooh, take it. This number marked out here, you do see this little note here. You probably can't read it. That is the quarterly open. This is also for May, the bearish engulfing line. A close below is a bearish engulf on the monthly. It's a red quarterly, etc. Bad news bears. Well, I guess good news for bears below there. Bad news bulls below there? I don't know. Is what it is. We are now within 15 seconds. Start Googling. Fire up the Google cannons. I'm gonna put on my favorite hype song. Oh no. Oh no. Too much pressure. Ooh, I wonder, since I don't pay for this anymore, if I can't search. My alert reminding me it is time. Start Googling. Google harder. Google faster. Google more intensely. I wish I could sort by published. None of these are in the last 1 minute, so none of these are what we are looking for. 18 minutes ago, 6 minutes ago. Nope, doesn't count, doesn't count. Gotta get something in the last literally 1 minute. Why can't I search by 1 minute? Custom range? There's no time for custom range. There's no time. 16 minutes, 6 minutes, 23 minutes. Why are none of these? I don't know how you guys find them so fast. Let me open investing.com. Maybe they'll have it. I'm seeing 525s in chat. People are typing fast. Bloomsburg 25. Latest. Has to be, remember, it has to be published within the last minute. Bloomberg Fed interest rate hike. 25, 25, 25, 25. Yeah, you're in the 50s. Anytime. Last hour. 31 minutes. 16 minutes. 50 minutes. 10 minutes. Forex Factory. I think the problem is on Google, it really just doesn't show up right away. 2 minutes ago. Here we go. Well, 2 minutes ago is still too long ago. 1 minute ago. Fed issues FOMC statement. Fed hikes by 25. Economic activity expanded at a modest pace. At a modest pace. I think 25's in. I think 25's in. Fed opens door to rate hike. Ooh, Jenkins. Wow, that's a really old. Are we live on Twitch? I don't even understand. How are so many people following us on Twitch? Well, shout out to Sivada for prime subbing on Twitch. I haven't been live there in years, but shout out. Let me open these charts here quick. Vela Cafe subscribed. Wave Life Beat subscribed. Road subscribed. One King subscribed. Not the only one. Many a king and queen subscribing today. Barry DeBarman's on Twitch. I don't know what's going on, you guys. Here we go. As expected, we are seeing some pretty extreme volatility. The dollar is on a little dumpy. Let's go to the non-1 minute time frame so we get a little perspective. Stocks on a red candle. I don't know. I guess we're famous on Twitch now. Dollar is dumping. Let's pull up the dollar because that seems to be the biggest mover at the moment. The market not loving this decision. Not loving it. We have not broken this month's low even with this red candle. The 1 minute is really a dangerous time frame to be on. In fact, we haven't even broken last week's low. What? You guys are cracking me up with these freaking Twitch. I don't know what's happening. I don't even know. Why don't you subscribe on YouTube? That'd be good. That'd be good. That's a hefty candle there. Minus 0.28% in 3 minutes. Well, that doesn't sound big. That's pretty dang big for stocks. There we go. S&P 500 for the dollar. Stocks with a green candle initially, now flipping red. Bitcoin oddly seems not to be phased. Really just being like the special little brother. Just hanging out while the adults talk. I don't know. Dollar maybe rebounding a little bit along with stocks. Bitcoin frozen in time. I guess we're a Twitch channel now. Alright, we're a Twitch channel now. Let's see. Close this. Whatever. We turned into a TikTok channel earlier in the month as our TikTok overtook our YouTube in size. But I guess now we're going to Twitch. Is what it is. Blade Runner 322, Nut Royal Flush, Zogizmod, Shocks NM. Keep the hype going, boys and girls. Little bit of retracement. From the initial decision, markets recoiling on the news, digesting the news. We should get ChatGPT to do a little summary for us. Get this full story. Federal Reserve press release. Economic activity expanded at a modest pace. God, I hate the way they talk. Banking system. I feel like there's not going to be much here. Where do I find the Leroy Jenkins? That is so loud. That is so loud. You guys are trolling me. Trolling me with the subs. Trolling me with the... I'm starting to think we're just live on Twitch now. Some parallel universe. Let's end this poll because we know the answer. The real answer, though, guys, was TomPow 2028. Sorry, everyone was wrong. Sorry for everyone who was wrong. Keep the subscribes coming. Keep the likes coming. Keep hyping. We have Mr. Chairman himself joining us in just a little bit. Just a little bit. Hang tuned. If you have to go before then or during the speech, feel free to leave a tab open. It'll help the stream out. I'm just saying. You can have a muted tab. Savada joined. Mint Poo. Great name. Great name, Mint Poo. Better smelling than the regular poo. Where's the HTML or whatever version? We should get ChatGPT to summarize this for us. The committee seeks to achieve maximum employment. They just repeat themselves all the time. The committee has decided to raise the target rate for the federal funds to 5.25%. The committee will closely monitor incoming information. It's almost like TomPow told us this earlier. Closely monitor incoming information and assess the implications for monetary policy. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account this literate, like TomPow told us this. We don't even need to read this. What I want to see is, what do they say about going forward? That's going to be the clinch. That's going to be the clinch today. The clutch, whatever. It's going to be the clutch part. What they're going to do going forward is more important. Virtually everyone expected a 25 BPS. We saw at the beginning of the stream, TomPow himself said 25 BPS. Now confirmed. But the important part is what is happening going forward. And according to this little PDF thing, it does not really seem to say much. Minimum bid rate, overnight repurchase agreements, rollover. So, well, let's do this. So, with the 25 BPS that was expected, we virtually guarantee that more banks holding too many, or I don't even think too many is appropriate. Banks with overexposure to U.S. bond yields, we almost guarantee more will become insolvent. I mean, all banks are insolvent, realistically. There's no such thing as a solvent bank. They're only solvent if the government backs them. Or not backs them, like prints money for them if they need it. But by definition, banks are not solvent. They lend out money they don't have. That's insolvency. But with this increase, we virtually guarantee a fifth bank will be on the horizon. Which one do you think it is? Which bank is next? Because it's coming. If they do pause, because that thing said they're open to a pause. If they do pause, we can see some relief, but that really isn't a fix. It's not a fix to the problem. Interest rates have to return, I believe, to like 2% for most of these banks that have exposure to U.S. bonds to be safe. We are nowhere near that. So what will be interesting, and you know they're going to ask about it today, is what the schedule looks like for the rest of the year. Chairman Powell hopefully is going to provide some guidance there. At what rate they plan on reeling them back, or even, like, I guess they're open to a pause, but is he committing to a pause? I don't see anything in the language here. If someone, I'm not going to open Discord. I've made that mistake before. It's frozen the camera. I'm not going to do that today. I'm going to do that today. Wow. Gold 13 Dragon the Real subscribed. Jimma Chain subscribed. Keep them coming. If you're out there and you haven't subscribed yet, you haven't hit the like button, you know what to do. A chirpow. What's up, Matthew D? Bitcoin is just totally ignoring this thing. Like, it's just totally ignoring everything going on. This is very unusual. I will say the highest volatility typically comes when Powell speaks, but wow. Wow. Like, the dollar is more volatile. Bitcoin is the stable coin today. The dollar is the Pepe, apparently. That was quite a dump. It has not fully retraced where it dumped from. Bitcoin is literally like right where it was. Stocks slightly down. Slightly. Let's take a peek at the dollar here on a less crackhead time frame. Nah, never mind. Same crackhead time frame. Let's use our fib tool. Where are we at? We have closed the candle above the 618 retracement, so looking likely the dollar's seeking back at least. I mean, I would not bet on this. As I said earlier in the stream, guys, today is a crazy day to trade. I don't do it. Dollar looks like it's coming back to support, previous support that was broken, because it has closed above the 618 retracement level. This is not a big move, mind you, but just a little short-term TA for you while we wait. Stocks very muted. It's interesting that the volatility here is weighted on the dollar. Stocks closed a 0.04% down candle, then a 0.06% down candle, while the dollar closed a 0.18% down candle. That the dollar is more volatile than stocks on this interest rate decision. That's pretty wild. Let me put this arrow back. There we go. I can't really make any call on Bitcoin. It's literally doing nothing. It's just like sitting in the corner, and it's like, have you heard about blockchain? Have you ever heard about the blockchain? There we go. The dollar back to the previous support that it dropped from. Are you retracing? Are you rejecting from here? Or are you going higher, dollar? Stocks are moving down. That could signal the dollar's looking to make a move to the upside. We have less than 20 minutes till Chairman comes on. And there we go. Right at the point. There's the dollar, little red candle. That's too predictable. I don't trust it. It's a trap. Something I will say I don't love about Bitcoin here is relatively flat bottom and our highs coming down. That could be the setup for a little bit of a dump ski into the speech. But if the dollar rejects here, maybe not. What really catches my eye and what's going to be, I think, the most eye-catching thing. I'm sorry, I'm still trying to get my hype down. What really catches my eye here is, one, the dollar being the most volatile. We don't see that typically. The dollar does not typically move more than stocks and Bitcoin on these events. This could have more implications. It could suggest there is more spice to come into Powell's speech. What's hella interesting is stocks are down, and technically the dollar is still down from where it started. But Bitcoin is completely sideways. We did see a little bit of this behavior on the last FOMC, where we didn't see the clear kind of correlation that we have seen many FOMC in a row. Basically, the dollar goes up, Bitcoin stocks dump, or the dollar goes down, Bitcoin stocks go up. I can't remember last month exactly what happened in March's FOMC, but I do remember a little bit of strangeness, and I'm seeing that strangeness again. Bitcoin is not reacting, at least yet. We still have Chairman to come, but it is just moving sideways. Well, stocks have trended down, and technically the dollar did too. This is not the setup I was expecting. Something tells me at 2:30 p.m. in just a few minutes it's going to get hella spicy. Zooming into the dollar, we have not broken, it looks like, the previous low. So while that move looked spicy, not a lot has happened. We're still technically at a higher low on the week, and a higher low on the month versus last month. That is an ugly candle. But we're only a day, 2 days into May. It is way too early to look at a monthly candle and say that's how the candle's going to close. That's just not how charts work. On the quarterly, we are still contesting with, I'll call a lower low, but we could say a double bottom. On the quarterly, we have almost 2 months of this quarterly left. So again, same logic, too early to start saying double bottom on the quarterly. Boom. Look at this. Look at this TA. Put that in your TA pipe and smoke it. Put that in your TA pipe. Nah, put something better than that. This right here is mids. Don't put mids in your pipe. Look at that perfect rejection. Higher lows still technically on the 1 minute, so we still may see a flat, I guess we'll call it a ascending triangle. There we go. If we invert the chart, something like this, which would lead to a move to the upside. Let's see. I love having Steve here because I catch myself being too bullish. It adds balance to my life. I'm like, nah, kid, I know Steve's crowd's here. They'll call me out if I'm too bullish. Gotta be more biased. There we go. That's not a great place for the dollar to reject. Really, mostly because it's still, even with that retracement, didn't make it back to where it was. I'm not sure what to think of this, though. I think there's a piece of this puzzle that's about to appear when Chairman speaks. It is 2:14. He speaks at 2:30. He will join us live from wherever the hell the Fed is. I'd assume DC. I don't know. You'd think I would know these things, but you'd be wrong. You'd be wrong. Let me read the chat. What's up, 1 day rewards? Schwag left in the sun for 2 weeks. Ew. Oh no. Oh no. No. You must be from near where I'm from because I know that term. Juzel90. They mentioned 2% inflation target several times, and the last paragraph is basically saying they will stay data in. That's what they always say, though. That's the thing that trolls me. That's why I troll them back, is they always just repeat themselves. They're supposed to give guidance, but they don't give guidance when they repeat themselves. I can make the admission that they have stayed to their word pretty closely over the last year plus. However, you have to then remember back to when these were also the people telling you inflation was transitory. They were telling us, don't worry, it's not happening. If it is happening, it's not going to stick around. Now they're how many interest rate hikes in a row deep? Like 13, 14. At a historically fast pace. It's very confusing. They, in one way, have stuck to their word, and then in the other way, have done like a little sleight of hand move of like, no, look over here, it's not real, it's not real. And then when they couldn't say it's not real any longer, they changed their narrative. I have never been so excited to hear Chairpow, and I'm excited to hear Chairpow every month. Never been so excited. I think he has a curveball. I don't know what that curveball is. I don't know the future, but the future is coming 1 minute at a time. We're almost there. Anuj S. Nier subscribed. Be like Anuj and subscribe if you haven't. We have 2,000 people watching here. If you are sitting there and you haven't hit the subscribe button, you're not invited to my birthday party. Yeah. Think about that. Brew that. Brew that in your old noggin. Let that mix around up there. You don't want to go to my birthday party? That's pretty effed up, man. Smash the likes. What's up, Trade Intuition, my man? Crypto Sharknado Edge seems up. I don't know what that means. Fellowship of the Lord of the Rings here. Sure. I like Lord of the Rings. I'm a nerd. Hit the like button if you're a nerd. Let's do a new poll, because I know we have bears and bulls in the chat. Let's see. Let's see what our take is. Let's have 4 options. We'll do bigly up, up, down, bigly down. There you go. Vote in the poll. Let's get a good sample, because usually it's just our crowd, but we have the optical art crowd here as well. I'm curious what the result is of this poll, and also just burning time. We have about 10 minutes until Chairpow. Tom Crown poll for themed party. Ooh, what theme should we do? What prom theme are we doing for my birthday party? When's the birthday party, Jeff? Soon. It'll be the same time as Moon, roughly. Roughly the same time as Moon. Birthday party. You guys crack me up. Dollar is still struggling to recover from where it dumped on the interest rate decision, which also doesn't really make any sense. Though there's a lot of moving parts here. Interest rate increases should strengthen the dollar. However, putting banks in jeopardy, forcing FDIC insurance to activate, and Fed picking up banks may be inflationary. This is why I said at the beginning, or no, not me, excuse me. TomPow said at the beginning, there's really no good choice. No matter what they do today, is not a good result. They either fight inflation or they fight banks. It's lose-lose. They backed themselves into a corner, and as I've said for years now, covering these, they've kicked the can down the road, and eventually you run out of road. Sure, you can build some road. You build a little more road. Eventually you run out of asphalt. Then you're really out of road. They may be at that point. There may be no more asphalt. Maybe no more road. No more gravel. No more cement. They've built all the roads. I like it. We have 350 votes. Very even. Very even here. Bullish to bearish. I like that. I like that. Means we have a good audience. Not enough votes yet to really determine a winner. So I'm not going to. Weekly BTC engulfing candle. I don't think it's engulfing yet. I know on the monthly we are slightly above the bearish engulf on the monthly here for May, with 28 days to go. It's not even relevant to look at it. More relevant will be the week. There's no engulfing on the weekly at all. Not sure where you got that from. What I do see on the weekly though is a little inefficient price action last week this week has wicked down to the fair value gap. Fair value gap filled. Prices back up. 4 days and 6 hours to go. Weekly is like not even half done. Again, too early to call, but the fair value gap was tapped. And that provides some solid entries. Wow. Actually, what's really spicy is this is almost the exact same setup on the day. You have inefficient price action, boop, fair value gap back up. Actually, this is kind of cool. This is kind of cool. Let's add our daily open here. It's wild to me that Bitcoin is just hanging out here while the dollar experiences volatility, right? Who's ever thought of that? Who's ever expected that? Not me. Beautiful. I thought I sensed something. Little taps here on the 1 minute candles. That is our daily open. So essentially, right before the interest rate decision, Bitcoin was trading on a green hammer daily into the interest rate decision. It dumped back into a red candle on the day. And since then, now it's tapped the daily open once, twice, maybe 3 times. We'll see. Spicy. So above this white line, we have a green day. Below that white line, we have a red day. And Bitcoin's just hanging out there. Dollar has kind of come back, still painting those higher lows. Dollar also, in my opinion, looking to retest, similar to Bitcoin, looking to retest that level. Stocks are very stockly. I don't like stocks, man. What is this? It's like a kindergarten, just like doodle. It looks like the chart glitched out. Like it's so neat and uniform. So neat and uniform, and then just glitched out. I guess we'll set an alert down here. Hopefully I have alerts. Set an alert. Ooh, that was actually a very high wick, wasn't it? And an alert up here. Any movement in between our high and our low here on the 1 minute is pretty irrelevant. Dollar, I'm going to take 101.397 above there. Something's happened. Bitcoin finding a little resistance there at the daily open. This is spicy though. I like this. Only a few minutes left till Chairman Powell is live. How many times will he say the same sentence over in a row? Is the question. We should do a bet. How many times will he repeat himself today? The answer is many. Many times. 561 votes. Well done. Keep voting. Keep smashing the like. Keep subscribing. Make sure you join the Discord. Check out the links in the description below. It's still very, very close. We're seeing about a 53% bullishness to a 47% bearishness on the poll there. Not enough votes yet to make a call. Keep engaging with the chat. Stocks making a move to their swing high. I'll take it. Bitcoin still just being the special friend in the corner. Like, why isn't anyone paying attention to me? What's happening? Oh. I think I've lost the ability to select songs on my music player because I stopped paying them because they never responded to my copyright thing. Oh wait, no, maybe I can. Ooh, I can still search maybe. Wow, that's really slow. Hopefully we're not losing connection because that is searching at the speed of a turtle. 1,000 results found? No. No. What? What? I typed in literally the name of the song and the artist, and it says 70 results found. That is stupid. I'm trolled. This similar search? No. This is why I don't pay for this anymore. Because they've broken this thing. I'm sad now. I can't find my favorite song. It's Mortal. I guess I could just pull it up on YouTube. Well, screw that. That's not working. Oh no, what if I can't find it on YouTube? Okay. Whatever, I'll stop talking about the song. We have less than 5 minutes. We have like 3.5 minutes until Chairman joins us. What should we do? What should we do in the meantime? What do you guys think? I'm like closing tabs so the computer hopefully doesn't explode. 700 votes, keep voting. Keep subscribing, keep liking. It's a great time to subscribe while we have a minute here because I can shout you out. Once Chairman starts speaking, I will not be doing shout outs. We'll be disabling the alerts because we do not want to interrupt us. Optical Art Army. I appreciate you, Steve, man. Love you, brother. Love all you guys. Love the whole fam, whole community. Whatever we think direction price is going doesn't really matter. At the end of the day, we're all here for crypto, and that makes us the great minority. I keep seeing numbers that are like 10% or 40% of millennials or something about crypto. I don't believe it. I don't believe it. Like, I don't believe it. I don't know if they're like hopium numbers or what. Does look like stocks might be looking to make the move first here, approaching their wild swing high at 41.50, climbing stairs up after some kindergartner doodles. Dollar pretty much sideways, but we are seeing higher lows, so we're still seeing that potential upside break pattern, testing resistance, weakening it, and Bitcoin still flirting with its daily open, almost completely unaware of what's going on around it. I vibe with that, though. I vibe with that, Bitcoin. Like, I feel you. I feel you. Millennials, Gen Z, the gimme generations. Crypto Crabman. Who do you think's here? Who do you think's here? People of all generations are welcome here. Crypto doesn't care how old you are. Doesn't care. Bitcoin does not care at all about anything. Doesn't care who you are, where you're from, what you think. I think... doesn't care what you think. I try to be like Bitcoin. I focus on me. I don't focus on others. It's almost like they don't exist. Well, in some ways, because I care about people. All right. We've got less than 2 minutes to go. Let's see if they've fired up the stream yet. They have their chillin' music. Do, 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 do. I was really hoping to play this song. Really wanted to. I literally cannot find it at all now. Turn that off. Spotify? Just sign in? I'm not signing in. I'm not bullshit. I just want to listen to the song. We have like just enough time to play it, but maybe we don't now. It's starting. Get hype for Chirpo. Get chirp hype for Chirpow. This is good music. Screw my favorite song. This is elevator dancing music. What's up, Joel De Leon? Sun Chips, BTC only cares about going to the right. That it do. It always goes to the right, 100% chance. Except on Bittrex. What's up, Philip? Ugolini. Crypto Ward 74. Everyone out there who hasn't subscribed yet, now's your moment. Before he gets on stage, smash it. Smash it, you get shouted out. Once it starts, shout outs are over. It's gone. There he is. Nope, there he's not. Why is it's above me? There we go. He's late. TomPow wasn't late. This is why you're just the chairman and not the super chairman. There he is. God, how many? 51 seconds late. JV.
Good afternoon. Before discussing today's meeting, let me comment briefly on recent developments in the banking sector.
Ooh, spicy
Conditions
start.
in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode, and will work to prevent events like these from happening again.
What?
As a first step in that process, last week we released Vice Chair for Supervision Barr's review of the Federal Reserve's supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 1/4 percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year, job gains averaged 345,000 jobs per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 0.25 percentage point, bringing the target range to 5 to 5.25%. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In addition, the economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses. In turn, these tighter credit conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain.
How could he say that?
In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we are prepared to do more if greater monetary policy restraint is warranted. We remain committed to bringing inflation back down to our 2% goal and to keep our longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Word for word. Gina, shut up. Everybody shut up. Gina's on. Shut your mouth.
Hi, Gina Smilik, New York Times.
Okay.
Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June. And I also wonder if the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so, what a recession like what they're envisioning would look and feel like when it comes to, for example, the unemployment rate.
Great question.
So, taking your question, of course, today our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation at 2% over time, the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting.
No, you won't. You won't. Look at that face. She's like, bullshit.
The staff's forecast is, so let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate this year. And I think that's, so different people in the committee have different forecasts. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions. I wouldn't want to characterize the staff's forecast for this meeting. We'll leave that to the minutes, but broadly similar to that.
Rachel.
Didn't answer anything.
Thank you, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I'm wondering if you can talk about the account of possible effects of a debt limit standoff. You've said repeatedly that the ceiling must be raised, but do you see any economics effects of even getting close to a default, and what type of situation would that look like?
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policy matters, for starters, and they're for Congress and the administration, for the elected parts of the government to deal with, and they're really consigned to them. From our standpoint, I would just say this. It's essential that the debt ceiling be raised in a timely way so that the U.S. government can pay all of its bills when they're due. A failure to do that would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite averse. So I'll just leave it there. We don't give advice to either side. We just would point out that it's very important that this be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential, short and long-term effects of a failure to pay our bills on time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bills.
And just to follow up, was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision at all?
I wouldn't say that it did. It was, of course, it's something that came up. We talk a lot about risks to the outlook, and that come up. A number of people did raise that as a risk to the outlook. I wouldn't say that it was important in today's monetary policy decision yet.
Steve.
Chairman, thank you.
Chairman Powell.
Steve Leisman, CNBC. Can you tell us what the Federal Reserve Board did in the wake of that February presentation where you were informed that Silicon Valley Bank and other banks were experiencing interest rate risks? And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle, that monetary policy and supervision can be handled with different tools? Thank you.
Sure. So the February 14th presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it very carefully. I did remember it. And what it was a general presentation. It was an informational briefing of the whole board, the entire board. I think all members were there. And it was about interest rate risk in the banks and lots of data. And there was one page on Silicon Valley Bank which talked about the amount of losses mark-to-market losses they had in their portfolio. There was nothing in it about that I recall anyway about the risk of a bank run. So it was, I think the takeaway was they were going away to do an assessment, a horizontal assessment of banks. It wasn't it wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing, and I thought it was a good presentation, and as I said, did remember it. In terms of what we're doing, of course, I think banks themselves or many banks are now are attending to liquidity and taking opportunity now, really since the events of early March, to build liquidity. You asked about the separation principle. Like so many things, it's very useful. But ultimately it has its limits. I mean, I think in this particular case, we have found that the monetary policy tools and the financial stability tools are not in conflict. They're working well together. We've used our financial stability tools to support banks through our lending facilities. And at the same time, we've been able to use our monetary policy tools to foster maximum employment and price stability.
Mr. Chairman, I'm sorry. I don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean, I didn't say it wasn't alarming. It was, they're pointing out something that they're working on and that they're on the case. That I'm not sure whether they mentioned, I think they did actually. They mentioned that they had taken regulatory action, or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank and there are many other banks that are experiencing these things, and we're on the case.
I thought you said they were strong, Mr. Powell. Answer how they're strong if they're collapsing. Every hand in the room. Every hand in the room.
Hi, Chair Powell. I wanted to ask, obviously, with the recent bank turmoil, we've seen multiple banks buy other banks, and I was just curious whether you think that further consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the U.S. Getting even larger.
So, we certainly don't, and I don't have an agenda to further consolidate banks. Consolidation has been a factor in the U.S. banking industry really since interstate banking, and before that even. It goes back more than 30 years. When I was in the government a while back, I think there were 14,000 banks. Now there are 4,000 and change. So that's going on. I personally have long felt that having small, medium, and large-sized banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes, and the various kinds of GSIBs do as well. So I think it's healthy to have a range of different kinds of banks doing different things. I think that's a positive thing. Is it a financial? So I would just say, in terms of J.P. Morgan buying First Republic, the FDIC really runs the process of closing and selling a closed bank completely. That is their role, so I really don't have a comment on that process.
No comment.
As you know,
on
there's
banks.
an exception to the deposit cap for a failing bank. So it was legitimate, and I think the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
So, but do you have any concerns about the fact that they're getting larger in general?
So I think it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's actually a good outcome for the banking system. It also would have been a good outcome for the banking system had one of the regional banks bought this company, and that could have been the outcome. But ultimately, we have to follow the law in our agencies, and the law is it goes to the least cost bid.
Colby. Thank you. Colby Smith with the Financial Times. At the March meeting, you mentioned that a tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
Yeah, I think I followed that up by saying it's quite impossible to have a precise estimate of the words to that effect. But in principle, that's the idea. When we've been raising interest rates, and that raises the price of credit, and that, in a sense, restricts credit in the economy, working through the price mechanism. And when banks raise their credit standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other, although firms are trying that, and we're trying it. But ultimately, we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving a sufficiently restrictive stance. But I think conceptually, though, we think that interest rates, in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong then, if it's having some kind of substitute effect?
This is just something that we have to factor in as we want to find ourselves. So I guess I would say it this way. The assessment of the extent to which additional policy firming may be appropriate is going to be an ongoing one, meeting by meeting, and we're going to be looking at the factors that I mentioned that are listed in the statement, the obvious factors. That's the way we're going to be thinking about it. That's really all we can do. As I say, it does complicate. We have, a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot of literature on that, but translating it into rate hikes is uncertain. Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening with lending. There's a lot of data on that, and we'll factor that into our decision making.
Howard Schneider with Reuters. Thank you. So noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
That's going to be an ongoing assessment. We're going to need data to accumulate on that. Not an assessment that we've made. That would mean we think we've reached that point, and I just think it's not possible to say that with confidence now, but nonetheless, you will know that the summary of economic projections from the March meeting showed that at that point in time that the median participant thought that this was the appropriate level of the ultimate high level of rates. We don't know that. We'll revisit that at the June meeting, and that's we're just going to have to. Before we really declare that, I think we're going to have to see data accumulating and make that, as I mentioned, it's an ongoing assessment.
And a follow-up on credit, if I could you give us a sense of what the SLUS survey indicated? It was already, I think 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to release the results of the SLUS on May 8th, in line with our usual time frame. And I would just say that the SLUS is broadly consistent when you see it with how we and others have been thinking about the situation and what we're seeing from other sources. You will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. Banking data will show that lending has continued to grow, but the pace has been slowing really since the second half of last year.
Go to Nick.
Nick Tamaros of the Wall Street Journal. Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year. So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down the pace was to see the effects of your moves, and now you've, for the last two meetings, been seeing the effects of those moves. Why did the committee feel it was necessary to keep moving?
Well, the reason is that again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time. And that's what we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to see more data, and it will continue to do so. So we really we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that.
And just to follow up, what you said in response to Howard's question, you'll need data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle?
As I
more
mentioned, I would just say that this assessment will be an ongoing one. You can't with economic data. You can't. You've seen take inflation from it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think you're going to want to see that, that a few months of data will persuade you that you've got this right, kind of thing. And we have the luxury. We've raised 500 basis points. I think that policy is tight. I think real rates are probably, you can calculate them many different ways, but one way is to look at the nominal rate and then subtract a reasonable estimate of let's say 1-year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what many people anyway, would assess as the neutral rate. So policy is tight, and you see that in interest-sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel like we may not be far off, or possibly even at that level.
Thank you very much, Chair Powell. Edward Lawrence with Fox Business. So if the Federal Reserve gets down to the 3% inflation, as the projections show at the end of this year, or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
Would you be okay with a prolonged 3%?
It's.
Look at the
let
data.
me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean, that's not a question that's in front of us, and it would depend on so many other things. But ultimately, we're not looking to get to 3% and then drop our tools. We have a goal of getting to 2%. We think it's going to take some time. We don't think it'll be a smooth process, and I think we're going to need to stay at this for a while.
How does the other side of the mandate, the job side, once you get to 3%, going from 3 to 2, how does the other side of the mandate balance?
I think they will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings, even with the lower job openings number, for every unemployed person. We do see some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. Wages, you all will have seen the wage number from late last week, and it's whenever it was, and it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments, but the labor market is very, very strong. Whereas inflation is running high, well above our goal, and right now we need to be focusing on bringing inflation down. Fortunately, we've been able to do that so far without unemployment going up.
Matt. Hi, Chair Powell. Matthew Boesler with Bloomberg News. So many analysts noted at the time of the March FOMC meeting that at least half of Fed officials' projections did imply or seem to imply that a recession was in their baseline forecast as well, given the strong first quarter GDP tracking estimates. And so I'm just wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed staff's forecast, possibly also the broader committee's forecast as well, and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the Summary of Economic Projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand, really, in the labor market. It's interesting, as we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%, pretty much where it was, even lower than where it was when we started. So job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. You know, it wasn't supposed to be possible for job openings to decline by as much as they've declined without unemployment going up. Well, that's what we've seen. So there are no promises in this, but it just seems that to me that it's possible that we can continue to have a cooling in the labor market without having the big increases in unemployment that have gone with many, prior episodes. Now, that would be against history. I fully appreciate that. That would be against the pattern. But I do think that the situation in the labor market with so much excess demand, yet wages have been moving down. Wage increases have been moving down, and that's a good sign, down to more sustainable levels. So I think it's still possible. I think the case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is. I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
The committee also noted in March that wage growth was still well above levels that would be consistent with 2% inflation. Do you see that as well? And could you kind of explain, how you come to that judgment?
No. Sure. So we look at a range of wage measures, and then that's a nominal. And then so you assume wages should be equal to productivity increases plus inflation. And so you can look at the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four, and many others, and you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. Later in expansion. So, yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that, if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time. By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that. That wages are really the principal driver, because I don't think that's really right.
Great. Chris Rugaber at Associated Press. Well, you mentioned profit margins. Those have did expand sharply during this inflationary period. And while there are some signs that they are starting to decline, many economists note they haven't fallen as much as might be expected, given that we're seeing at least some pullback among consumer spending. So, speaking of causes of inflation, do you see expanded profit margins as a driver of higher prices? And if so, would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand. Too much demand, not enough supply. And we've been in a situation in many parts of the economy where supply has been fixed or not flexible enough. And so, the way the market clears is through higher prices. So I think as goods pipelines have gotten, back to normal, so that we don't have the long waits and the shortages and that kind of thing, I think you will see inflation come down, and you'll see corporate margins coming down as a result of a return of full competition, where there's enough supply to meet demand, and then you're really back to full competition. That would be the dynamic I would expect.
Michael McKee from Bloomberg Radio and Television. Can you tell us something about what your policy reaction function is, your policy framework is going forward? When you look at the economy at the next meeting, are you looking at incoming data, which is by definition backward looking? Are you going to be forecasting what you think is going to happen? Are you ruling out the rate cuts that the market has priced in?
I didn't catch the last part. Ruling.
Markets have priced in rate cuts by the end of the year. Do you rule that out?
Okay, I got it. So what are we looking at? I mean, We look at a combination of data and forecasts. Of course, the whole idea is to create a good forecast based on what you see in the data. So we're always looking at both, and it will, of course, it'll be the obvious things. It'll be readings on inflation. It'll be readings on wages, on economic growth, on the labor market, and all of those many things. I think a particular focus for us going now over the past 6-7 weeks now, and going forward is going to be what's happening with credit tightening. Are small and medium-sized banks tightening credit standards, and is that having an effect on loans, on lending? And so we can begin to assess how that fits in with monetary policy. That'll be an important thing. We'll be looking at everything. Again, I would just point out we've raised rates by 5 percentage points. We are shrinking the balance sheet, and now we have credit conditions tightening, not just in the normal way, but perhaps a little bit more due to what's happened. And we have to factor all of that in and make our assessment of whether our policy stance is sufficiently restrictive. And we have to do that in a world where policy works with long and variable lags. So this is challenging, but
we'll monitor the data
we will
in
make
real
our best
time and make
assessment, and
decisions.
that's what we'll be thinking.
What about the idea of rate cuts?
Yeah, so we on the committee have a view that inflation is going to come down, not so quickly, but it'll take some time. And in that world, if that forecast is broadly right, it would not be appropriate and to cut rates, and we won't cut rates. If you have a different forecast, and markets have been from time to time pricing in quite rapid reductions in inflation, we'd factor that in, but that's not our forecast. And of course, the history of the last 2 years has been very much that inflation moves down. Particularly now, if you look at non-housing services, it really hasn't moved much, and it's quite stable. And so we think we'll have to. Demand will have to weaken a little bit, and labor market conditions may have to soften a bit more to begin to see progress there. And again, in that world, it wouldn't be appropriate for us to cut rates.
Courtney? Courtney Brown from Axios.
Great
I'm
voice.
curious how you view the role of the overnight reverse repo facility in the context of the current banking stress. Do you think it's contributing to the stress by making it more attractive for money market funds to compete with banks for deposits? And did the committee discuss any changes to the structure of the facility, or do you see that being put on the table in the future? Thanks.
Sure. So we looked at that very carefully, as you would imagine, and it's really not contributing. We don't think now. It hasn't actually been growing. It moved up, it moved down, and then moved back up to where it was. What happened in the when there were the big deposit flows, which by the way have really stabilized now. What happened was institutional investors took their uninsured deposits and put them in government money market funds, which bought paper from the federal home loan banks and things like that. Over the course of maybe the last year, retail investors had been gradually, as they do in every tightening cycle, they've been gradually moving their deposits into higher yielding places such as CDs and other things, including money market funds. So that's a gradual process that is quite natural and happens during a tightening cycle. What was unusual really was the institutional investors moving their uninsured deposits and spreading them around and things like that. But it doesn't seem to have had any effect overall on the overnight repo facility. That is really there to help us keep rates where they're supposed to be, and it's serving that purpose very well.
Sarah.
She had a great voice.
Sarah Weiss, CBS News. I want to go back to the debt ceiling for a moment. I know you talked about that in terms of fiscal policy, but can you just speak towards what the impact of a default would mean for Americans across the country, the markets, and borrowing?
It's not going to happen, Sarah.
Yeah, I would just say it's. I don't really think we shouldn't even be talking about a world in which the U.S. doesn't pay its bills. It just shouldn't be a thing. And again, I would just say we don't. No one should assume that the Fed can do can really protect the economy and the financial system and our reputation globally from the damage that such an event might inflict.
Scott.
Thanks, Mr. Chairman. Scott Horsley from NPR. In his report last week, Vice Chair Barr identified a couple of the factors that he thought contributed to the regulatory or the supervisory lapses at Silicon Valley Bank. A policy change in 2019 to exempt all but the biggest banks from strict scrutiny, and also what he called a sort of cultural shift towards less aggressive oversight. You were here in 2019. Do you share that view, and what would it take to get the stronger oversight that you and he said in your release would be necessary?
So I didn't take part in creating the report or doing the work, but I have read it, of course, and I find it persuasive. I mean, I would say it this way. A large bank, not a very large bank, a large bank failed quite suddenly and unexpectedly in a way that threatened to spread contagion into the financial system.
But banks are very strong, as I said
think
in the start.
The only thing that I'm really focused on is to understand what went wrong, what happened, and identify what we need to do to address that. Some of that may just have been technology evolving. We have to keep up with all that, but some of it may be our policies and supervisory and regulatory, whatever. Well, what our job is now is identify those things and implement them. And that's kind of the only thing I care about and I feel like I am accountable for doing everything I can to make sure that happens.
Thank you. Evan Reiser with MNI Market News. Chair Powell, are we in the early stage or nearing the end stage of the banking turmoil among regional banks? And secondly, do you still have a bias to tighten rates? Is that what the statement is saying?
So,
I wouldn't know.
I guess I would.
Look at the data.
I guess I would say it this way. There were three large banks, really, from the very beginning, that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved, and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period is an important step toward drawing a line under that period of severe stress. Okay. I also think we are very focused on what's happening with credit availability, particularly with what you saw in the beige book, and you will see in the SLUICE is small and medium-sized medium-sized banks who are feeling that they need to tighten credit standards, build liquidity. What's going to be the macroeconomic effect of that? More broadly, we will continue to very carefully monitor what's going on in the banking system, and we'll factor that assessment into our decisions in an important way going forward.
Okay, Greg.
Thank you, Fed Chairman. Greg Robb from Market Watch. I just wondered if you've done any reflection on your own actions during this crisis and leading up to it over the since you've been Fed Chairman. I think I've heard you say a couple of times that you deferred to the Vice Chair for supervision. Do you think that was the right way to go about this? And comments on that. Thank you.
Sure. So let me say, first of all, I've been chair of the board for 5+ years now, and I fully recognize that we made mistakes. I think we've learned some new things as well, and we need to do better. And as I mentioned, I thought the report was unflinching and appropriately so. I welcome it, and I agree with and will support those recommendations, and I do feel that I'm personally accountable to do what I can to foster measures that will address the problems. So on the Vice Chair for supervision, the place to start is the statutory role, which is quite unusual. The Vice Chair, it says, shall develop policy recommendations for the board regarding supervision and regulation of depository institution companies, and shall oversee the supervision and regulation of such firms. So this is Congress establishing a 4-year term for someone else on the board, not the chair, as vice chair for supervision, who really gets to set the agenda for supervision and regulation for the Board of Governors. Congress wanted that person to have political accountability for developing that agenda. So the way it works, the way it has worked in practice for me is I've had a good working relationship. I give my counsel my input privately, and that's, I offer that, and I have good conversations, and I try to contribute constructively. I respect the authority that Congress has deferred on that person, including working with Vice Chair Barr and his predecessor. And I think that's the way it's supposed to work, and that's appropriate. I believe that's what the law requires. And, you know, but it isn't, I wouldn't say it's a matter of complete deference. It's more, I have a role in presenting my views and discussing, having an intelligent discussion about what's going on and why, and you know, that's my input. But ultimately, that person does get to set the agenda and gets to take things to the Board of Governors, and really in supervision has sole authority over supervision.
Just wondered if you had any regrets, or was there anything that, you know, decisions that maybe you regret now in light of what's happened?
I've had a few.
I regret some things.
Sure. I mean, you know, who doesn't look back and think that you could have done things differently? But honestly, you don't get to do that. Again, my focus is on control the controllable. As one of my great mentors used to always say, control the controllable. What we control now is make a fair assessment, learn the right lessons, figure out what the fixes are, and implement them. And I think that Vice Chair Barr's report is an excellent first step in that, but we've got to follow through.
Man, lots of questions.
Great. Thank you. Hi there, Megan Casella with Barron's. Did the possibility of pausing at this meeting come up at all, and how seriously was that considered? I'm curious if you can give us any color as to whether there were any initial concerns about raising rates again, or what those discussions entailed.
So support for the 25 basis point rate increase was very strong across the board. I would say there are a number of people, and you know, you'll see this in the minutes. I don't want to try to do the head count in real time, but people did talk about pausing, but not so much at this meeting. You know, that there's a sense that we're much closer to the end of this than to the beginning. That, you know, as I mentioned, if you add up all the tightening that's going on through various channels, we feel like we're getting close, or maybe even there. But that, again, that's going to be an ongoing assessment, and we're going to be looking at those factors that we listed in to determine whether there's more to do.
I'm curious too how to interpret that and the changes to the statement.
Yep.
Is the bar higher now to raise rates at the next meeting, or would a strong jobs report or inflation print be enough to push the Fed to tighten again?
I don't want to. I couldn't really say. I just think
look at the data.
I think we've moved a long way fairly quickly, and I think we can afford to look at the data and make a careful assessment.
And we'll go to Nancy.
All right, Megan. She's no Gina, but all right.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. You mentioned a few times about the lessons you learned from the banking crisis, that you would learn the right lessons. What are those lessons?
Well, I just would start with
Let's look at the data to learn those lessons.
Something that's changed, really, which is the run on Silicon Valley Bank was out of keeping with the speed of runs through history. And that now needs to be reflected in some way in regulation and in supervision. We know now that we know it's possible. I think no one thought that was possible. No one had. I'm not aware of anybody thinking that this could happen quite so quickly. So I think that, that will play through. It will be up to Vice Chair Barr to really take the lead in designing the ways to address that. But I think that's one thing. I guess I would just say that then that we're gonna revisit. It's pretty clear to me anyway. It's clear that we need to strengthen both supervision and regulations for banks of this size, and I'm thinking that we're on track to do that as well.
Can you be any more specific on stress testing or looking at banks that have specific concentrations in certain parts of the economy?
Yeah, that's what Vice Chair Barr's role really is, and he'll take the lead on that.
It's never his thing. It's always someone else.
Thank you.
It's always someone else or the data. Chair Powell, have you considered looking at the data? No, I have not. Next question. Next question. That was ridiculous. Volatility wasn't so. Not so volatile. We got a lot of, they have a lot of, guys, there's a lot of data to look at. You know, they came to this meeting. It was very last minute. They have a lot of data to look at. And, you know, I couldn't answer that. Couldn't answer that. Trapao, what about banks? What about, are banks failing a bad thing? I couldn't answer that. We're going to have to assess the data and see how it is going forward. Wow. He never says anything, but it doesn't make it not fun. That's why we do these. We do them because he never says anything. Not a lot of forward guidance, but very hawkish tone. Very hawkish tone. Surprisingly, Bitcoin slightly down from where it started. The dollar virtually exactly where it started, and stocks down. Not quite the mix up we would expect. We did pull up JP Morgan down. I wouldn't have guessed that. Red candle on JPMs. Wouldn't have guessed that. Bitcoin dominance down slightly, not enough to get me excited. Giggity. Giggity, giggity. Wick low on the dollar. Probably looking to return to, I don't know, a meaningless high here. Sideways price action. It is what it is. You win some, you lose some. And a lot of the time, though, you just have to look at the data. Remember. Guys, this has been amazing. I want to thank TomPow for being here. I want to thank all of you for being here. Make sure you've liked, subscribed, joined the Discord, sign up with Femex or Fairdesk or MarketSite. The links in the video description below. I will be leaving tomorrow for NFT Talon in Estonia. I don't know how I'm going to make content while I'm there, but I'm going to figure something out for you guys. You know, I always think about you guys first. I love you all. Let's just end it on that positive note. I love you all. I will see you soon. TomPow out.